Good afternoon, everybody. Welcome to the Shut Up and Do It podcast, the place you can come hang out with us while we go through all things real estate with a focus on bringing you top quality topics and speakers, all who believe in a get it done manner. I'm your host, Nick Aalerud, creator of the Complete Deal Flow System and principal with AA Real Estate Group in the greater Boston area. We function as an educator and active single-family, multifamily investor in the Boston area and beyond. Folks, today we have like this super cool guest that I have no idea how I landed him. I think I tricked him into doing this podcast with us. We met recently at an event in San Diego, gorgeous San Diego, where there was absolutely no sun and it was like 50 degrees. I was really angry, us being in New England. But folks, with us today, we have Daren Blomquist. Daren is the formerly of RealtyTrac, where he kind of gave a whole bunch of, he was like the face of RealtyTrac, giving out data and trends and that sort of thing. He moved into Attom Data, which a lot of you know, because it's the basis of a lot of our skip trace companies. And he's currently with a small little company that you might have heard called auction.com. And I can't believe you're here today, Daren. Thank you so much for joining me today.
It's great to be here. Thanks, Nick. And yeah, there's no trickery involved. It's fun to do this and to talk about. So I always love talking with folks who are on the front lines of the real estate market. I look at the data a lot, and so it's good to get that perspective and stay in touch with people who are actually involved in those front lines and seeing what's going on in the market. So yeah, great to be here. And it's still foggy and cloudy here in Southern California, even in July. So you're not missing anything.
No, I'm not. But hey, listen, today is a wonderful July day in the Boston area, and I got to tell you, we got some sun. We've got like 78 degrees. It's almost like the beautiful paradise of the West Coast. Almost, but not quite. Daren, if you want to start, just kind of, your bio speaks for itself, but if you want to chat about a little bit where you came from and how you even got into real estate, and then the data side, that would be great.
Yeah, my background was actually coming out of college was in communications, journalism, communications. And after a stint in Illinois, that's where I went to college as a newspaper reporter for a couple of years, which is a great experience in and of itself. And you always touch on real estate when you're dealing with the news. But I moved to California and got a job with this little, basically it was a startup at the time called RealtyTrac, and I thought it would just be a temporary job. In fact, I got it through a temp agency, believe it or not, and was just like, okay, here's a job to keep me going until I find my real job. And they just kept on growing, and there was enough interest there that on my part that I just kept on saying, okay, I'll give it a little more time. And it really turned out to that was about 2001, 2002 through 2007. The company grew like gangbusters, which it specialized in providing foreclosure data, which there was a huge appetite for at the time because that was during the market boom, and people were looking for deals any place they could get them. And we were the first to kind of bring foreclosures. We called it democratizing foreclosure data, making it available online. And so the company grew like crazy. It was a fun ride and experience. In about 2005, we started putting out, I started using my skill set in communications a little bit more directly by helping to launch a foreclosure report that we put out to the marketplace. Not just, the individual foreclosure data on our website, but aggregate foreclosure trends. And in 2005, nothing special was happening with foreclosures. It was kind of just, we thought, we're not seeing this kind of data out there, so we're going to put it out in the marketplace. But then a couple of years later, we all of a sudden started to see those numbers spike like crazy. And we actually, I don't think we even knew at the time how significant what we were seeing was. And we were seeing really the beginning of the housing crash. And we actually got a lot of pushback from established institutional players in the space about well, your foreclosure numbers are overstated and maybe you're double counting this, that can't be going up. The numbers can't be going up this much. But at the end of the day, it turns out, and this, we may have stumbled into it more than anything, but we were right. And then things actually got a lot worse than from there. And we became, I think because we were willing to just go out and not sugarcoat the data and just put it out there, we became the go-to source for that data over the next 7 years, I guess it was 5 to 7 years, that where the crisis happened, and then the aftermath of the crisis for that foreclosure data, and that became a big part of my job is dealing with press inquiries, and then even government agencies were coming to us. And I remember getting a call at one point from the White House even about getting getting data for, I mean, it wasn't from the top of the White House or anything like that, but from the economic team there, wanting our data. And so got to, that was a fun ride being part of, obviously it was a tough time for the housing market, but being able to be kind of on the front lines of having that information that was important.
And like you said, you guys literally started before it all kind of got crazy. So you almost stumbled into this, but then you became the main and legitimate source for that data at the time. And people hear me talk about it all the time. Like, as a former banker, right? I saw that movie called The Big Short. I'm sure you've seen it. Yeah.
Mm-hmm.
So there was so little, the moment the media started reporting the truth, which was so infrequent, you were like the first and a lonely voice out there saying, hey, we're seeing something pretty significant. And then you have those institutional players and maybe government agencies being like, no, just squash this guy. Let's not have him. It's not even real data. You're double counting. Like, that's awesome. You were on the front lines of that, right? That's crazy.
Yeah, it was. And we made mistakes, with the data, and sometimes, to be honest, but we were not, I think what gave us credibility is that we didn't have an axe to grind in terms of wanting the data to look a certain way. Most of the players who were putting reports out there had a vested interest in making the market look more rosy than it was.
Yeah.
And I think I do think now what we started doing there was a lot of copycats of, and I think it's good for the market. There's a lot more data out there for investors and even just regular homeowners and home buyers to go out and see. And it's not just from a couple places, but there's a lot of folks putting out reports on the market. And I like to think of us as one of the first ones to, outside of kind of these established players who have been doing it for decades, to start, hey, we have this data. Let's make it available to the marketplace, not just hold it within our four walls. Now, that did also spawn, in some ways, our transition, because so RealtyTrac became Attom Data Solutions. And part of that transition involved the fact that, we realized this data we had that we were making available on the website there was also a big appetite for that, for people to buy that data in bulk, not just to buy it, through a website subscription where they could look at individual properties. And so that helped to start our transition from a more of a B2C website company into a bulk data provider. And eventually we moved so far in that direction that we changed our name to Attom Data Solutions to really get away from just the website concept.
Gotcha. Oh, crazy. That's cool. And then you did have your transition. In a lot of our audience members, Daren, they love to, and you don't have to go into it if you don't want to, but a lot of them like to see personal or professional challenges that we've overcome, right? That's why we actually got the name of this podcast as the Shut Up and Do It podcast. And I think you knew that already. We've talked about that a little bit beforehand. But are there any personal or professional obstacles that you've had to overcome that you're willing to share with us?
Yeah, I think really it became the biggest challenge I've faced professionally, at least that I can think of right now, is when I really came after 17 years at RealtyTrac, which then became Attom Data Solutions. It became pretty clear near the end of last year, 2018, that was I no longer had a path forward there professionally, and I was kind of pushed, and I was pushed, out of there. And I don't have, I think it's a great company, and I don't have bad feelings about it, especially in hindsight, because it really forced me to get out of my comfort zone there, which was a great ride over those 17 years. But I needed that kind of push to get out there and see what was available to me professionally, and it was a very encouraging experience, at least in hindsight. There was some heartburn, as I'm sure folks who've gone through similar transitions or who are considering jumping into real estate investing. It's not necessarily easy, but it was something that it forced me. One of the biggest things was just reaching out to people I knew and start using my network and talking to people, and not always with the objective of, oh, I'm looking for a job, but hey, I just want to get your advice as someone I know and trust. And people were amazingly generous with their time and advice to me during that time, which was a huge benefit of that, because if you're not forced to reach out to people, sometimes you don't do it just naturally. And so relationships that I had were forced into greater depth, and I got to know people and better and learn from other folks around me in my network. And then professionally, I did. Once I started talking to people, there were more than I expected in some ways. People that just said, hey, we're actually interested in your skill set. We'd love to have you. And so that became, it became an amazing opportunity for me to look around and actually be able to choose the best fit for my skill set and what I thought would be most fulfilling for me professionally. And that ended up being here at auction.com, where I really got to get into a role that was VP of market economics here at Auction, where I really get to do the parts of the job I really loved at Attom Data Solutions, which are really looking at the data, looking at the trends in the marketplace, and creating data-driven narratives out of that, telling the story of what's going on in the marketplace to our internal audience. That's my primary audience, at least my first audience is the business, because it's very important to this business what is going on in the housing marketplace overall, but more specifically the distressed marketplace. We are similar to probably your audience in that the business, and it's hard to put this in a way that sounds good, but when the market is doing poorly, our business can do better because we are helping to dispose of those distressed assets. And we believe we've democratized that marketplace, and so those distressed assets can be disposed of in the most efficient manner. But we're looking at that marketplace. That's one audience I get to look at the data and tell the story behind the data too. But also then going out, and I'm going to be doing this more as I mature in my position here. But talking to people like yourself and your audience, and sharing what we're seeing in the marketplace and what the opportunities are. And so that's what I'm doing. But all that to say, there was really a challenging situation that I was forced into. But rather than be a victim, I was able to, start reaching out and looking for those relationships, and it was very rewarding to deepen those relationships, and then of course understand that, hey, there's actually a world out there outside of Attom and RealtyTrac that is amazing.
That's awesome. Yeah, it's a great, and what do they say? Your network is your net worth, if it would be, right? So it is people at the end of the day, right? Most of my audience already knows that, Daren, and I know we briefly chatted in California, but similar situation where, I basically, had 5 hard reset buttons in the business world and the personal world. And every single time, like the first 2 times were like the hardest, and didn't really know how to deal with it. But like you just said, like strengthening those relationships, and really when you don't want to reaching out is what got me out of them too. So I 100% agree. And it's about people and relationships, whether it's real estate or fruit arrangements or data collection, or doesn't matter, right? So
yeah,
man, good for you. And you certainly landed in a place that, I'm not, I will speak for my whole audience. I'll say I'm pretty sure most of my audience knows of auction.com, and we're all pretty much turned on by market stats and market trends, and you are like the guy. So if you have if you have any data or trends you want to share, we'd love to hear whatever you want to share with us today. That would be great.
Yeah, I mean, the marketplace, the distressed marketplace is undoubtedly shrinking. I think your audience, probably you and all your audience, probably realizes this. But I mean, the exciting thing for us at Auction is that even though the overall pie is shrinking, we're continuing to grow our market share. So our over the last few years, we're actually selling more properties, even though the overall pie is shrinking. But I'll start there, is really that we continue to see signs of distress decreasing in this housing market. Now, I will point to a few potential cracks in the foundation that we're seeing, but those cracks have not yet developed into actually more distressed inventory available. But when we look at delinquency rates, for instance, and we look at various data sources, but the one I usually use is Black Knight delinquency rates, but really any delinquency rate that you look at is down. They're down to a new record low in May of 3.36% overall delinquency rate. And yeah, that's a record low going back to 2000. I mean, they've been tracking this since 2000. So this is not just a low for post-recession. This is a low for even back during the last housing boom, or leading up to the last housing boom, when you think delinquency rates would be low. So they're even lower. There are just fewer bad loans out there. And that's a good thing for the housing market. There's less of a internal weakness, at least when it comes to bad, inherently risky loans that are being generated out there.
So you think people learned on that one front from 05 to...
Yeah. So there's probably other mistakes that we're making right now. We're not making exactly that same mistake that was made during the last housing boom and during the excess of, oh, well, the market's always going to go up, so we can make these risky loans that are basically hinging on will only survive if the market continues to go up at the rate that it's been going up. Those types of loans, at least, are not being made in big numbers. And then we look at foreclosure starts from my previous company, Attom Data Solutions. Those are down. Those are continuing to decrease. Those numbers are kind of flattening out. There was a sharp drop from about 2012 through 2017, and we've seen those numbers kind of plateau around 30,000 foreclosure starts a month. So one thing, even though foreclosures have gone down to really a record low, at least as far back as we have data, they're still there. I mean, they haven't completely gone away. They're not going to go to zero. There are always people facing trouble, even in a great economy, even in a great housing market. You always have folks who hit those life challenges, like some of the ones that we've faced. And that's, so you're still seeing about 30,000 properties start the foreclosure process a month. And, and so that's not nothing, is a point to make. It is still very low relative to, we were actually seeing during the height of the crisis, as many as close to 200,000 properties a month start the foreclosure process. So we're well below that. And that means less inventory. It's harder to find inventory. One of the things, and actually maybe I can get into this a little bit if I can pull up really quickly, but I don't know if you remember, but at the conference we were at in San Diego, we were able to do a quick survey, kind of real-time survey of the audience there, that we provided, that Auction wanted to do to just understand this audience of investors out there. And one of the takeaways was, with the biggest challenge, I believe, that was identified by the vast majority of the audience was inventory, finding deals, finding inventory. And maybe that's not a big revelation, but I think certainly that that jives with these numbers that we're seeing. There's just not a lot of low-hanging fruit in terms of deals and inventory for investors out there. Is that what you're seeing?
Yeah, so it's funny because we used to rely on your data for our local regional markets, if you will. We have a short sale negotiation company that we're in charge of almost preventing them from getting to your clients to push to auction.com. But it's we are seeing the same thing you are. We're at record lows as far as I'm only speaking now for like Massachusetts and New Hampshire markets. But being at record lows, just like you mentioned, the life transitions are always there, right? A mom that maybe faces some medical issues, which then forces the daughter to, hey, do I take care of my mom or do I pay my mortgage this month? Like, there's always different reasons and different life transitions and different distress situations people get into that have nothing to do with predatory lending or have nothing to do with bad credit situations. So we're with you on that. And what I teach my students here today is that if they can learn how to source deals right now, which are offer on market, either way, like if they can learn right now how to source when the market does turn, because personally I feel that, and I'm going to defer to you on this, but I do feel like we are cyclical creatures as humans. Maybe that's accurate, maybe that's not, right? Let me ask you, you have the national data, I don't. And before we go there, I had another question I'd written down before, just to get to I'm jumping all over the place now because you got me all excited. Are there specific areas of the country or states that you would see start to swing first, or does it literally happen as like a sweep across?
I think especially in this cycle, what we're seeing, and I mentioned it earlier, there are some cracks emerging in the foundation of the housing market, whatever analogy you want to use. Some weaknesses emerging, but they do tend to be more regional in nature. There doesn't seem to be a systemic problem with lending, for instance, like we saw last time around, that is going to just hit all at once. That scenario would be more of an external shock if there was some huge financial crisis or some global type of political crisis. That could shock the housing market nationally more. But what we're seeing now is more regional. And honestly, I mean, it sounds maybe kind of silly to say it, but because maybe it's obvious, but one of the things that we've seen the biggest increase in distress, or one of the catalysts for increases in distress over the last couple of years has been natural disasters.
Hmm.
And, you know, it's sad to say that in some ways, but in some ways, it's also not any different than a financial man-made disaster. It does cause distress. And so in looking, there's a heat map that I created looking at using the Attom data actually on foreclosure starts, even though that 30,000 a month is down 9% from a year ago. And we're down, if you look at not just May, but year to date, we're down 8%. If you start looking year to date by market, the areas on this heat map that are lit up with increases that are counter to the national trend are actually you see a lot in Florida, a lot in Texas, and those were both hit by hurricanes. And that may surprise people because those markets are thought of as very strong, healthy markets. Mm-hmm. But places like Houston, Miami, actually all over Florida, we're seeing increases in foreclosure starts. And then even Atlanta, which was not as hit as hard by the hurricane. So that's one issue. Another issue, though, I think a challenge that is starting to pull at the seams is affordability. And this isn't quite the same as poor lending, but just people who, even with more solid lending standards, have stretched themselves financially and are getting into trouble. And so we're seeing increases. Now, the numbers are not very high, but we're seeing increases in places like Seattle and Portland in the Northwest, which I think is a little bit surprising. And actually, most of Coastal California is down, but San Diego, where we were a few weeks ago, has an increase. And I chalk those regional increases up to markets that are overheated, and affordability has become such an issue that you don't see this necessarily toxic loan products that are being used, but people have just stretched themselves so much that there is a breaking point for some of the people there, and when we're starting to see increases in those markets.
100%. And speaking
right now, right now we're seeing some regional weaknesses. I don't want to overstate it. It's increases off of a very low level, but it's increases nevertheless.
Do you foresee, just to piggyback on what you just mentioned, regionally again only, here in the north of Boston, southern New Hampshire market specifically, right? So if we do, I follow, I guess, micro trends here locally, right? And what we saw last time, like you mentioned, with the predatory loans, those aren't really here yet. But what I am seeing is that at least here, it's open data from the MLS to say, okay, if you're not in Boston proper or within like one of the 5 towns that touch Boston proper, any high-end homes, the high-end inventory has already stalled and even price declined, right? So I look back at 2007, 2008, which I know was a whole different set of circumstances, but that was also around here one of the first signs. Then it went to what we would consider like high-end condo markets that weren't, again, in Boston proper, but a little bit outside of Boston proper. And those high-end condo sales start to slow and then stale a little bit. And finally, it gets to the single-family market, which we're not seeing it completely yet, but at price points here, only locally, which are above, let's say, $600,000 price points. Anything lower than, let's say, $550,000 up here is considered actually first-time homebuyer range, which is crazy. Like you just mentioned, ability to repay and affordability is out the charts. And with, even my retail brokerage office, right, the buyers they want to buy. They're seeing everybody else buy homes and there's no inventory. So they're overpaying and overbidding and trying to stretch their loan officer to the maximum extent of their loans. And all it takes, like you said, is one employer one day to be like, hey, you know what? They just raised the minimum wage here again, which they did. So we got to cut your hours, right? So we got to cut your hours down to, 35 from 40. And what does that do to someone, or even a dual income family that's now, paying a mortgage with that? And we're right on that cusp. I feel Northern Mass, Southern New Hampshire market where our prices are, like you said, stretched to the affordability max,
Mm-hmm. Yeah. Yeah, I think that's one of the weaknesses in this market is affordability. Now, it's actually, I think, almost a good sign. Some of the slowdown that we're seeing, I think, is helping the market. I mean, a correction, you could argue that some sort of correction is needed, and it's better to have that correction happen early and often as opposed to this pent up correction building up and people papering over over it until all of a sudden it just blows up. And the pattern that I seem to be seeing is more of that move toward an early and often type of correction where the market responds more quickly and more nimbly. And I think part of that is more data is available. People are just more hyper aware. But yeah, I mean, on a more macro level, we see that same sort of pattern. I mean, the market with the biggest decrease in home prices in the first quarter, if you look even at NAR data, was San Jose, California, which is the highest price market in the country, basically. I mean, if you look at metro areas, and they've had 2 quarters of year-over-year decreases in median home prices in San Jose, and double digit. I think it was 11%. And so what you're seeing there on the micro level in your area, I think, is happening at the macro level when we look at markets, those markets that are just so high priced where affordability has become such a problem. The market is correcting, and inventory is going up as well. Naples, Florida is another one that I would call out where we're seeing price declines. That's more of a high-end market in Florida. Bridgeport, Connecticut is another one, and so yeah, that's a sign that of at least a correction developing in this marketplace.
Gotcha. I don't know if you've drilled down to the data at all, Daren, but is that a result of like new builds, like inventory that's becoming available, or is that existing inventory that people just, hey, everyone's getting a high price, let's flood the market,
That NAR data is all existing inventory that we're talking about there. And so now I think another weakness in the market, and this is definitely going to be regional in nature, is population trends. In places like San Jose, and I think in part because they're so unaffordable, are actually seeing people leave in greater numbers than they come. And of course, it's still got a very strong economy. There's a lot of people making a lot of money in San Jose, but it's a little bit of a country club effect where only a select few can afford it, and that's pushing other people out, which eventually does have an impact on the overall demand in that marketplace. And so that's where I see coastal California is a little bit of a weak spot because you see those population declines. If you look at the census data, even New York is another weak spot. The 5 boroughs, you see population, and actually I shouldn't say population, I'm looking specifically at what the Census Bureau calls net migration. But basically more people are moving out of those areas than are moving in. And for the last few years, international migration has helped prop up those coastal California and New York, because more people are enough people are moving in from outside the country that it helps kind of soften the declines. But if you look at the domestic migration, it's kind of off the charts in terms of negative net migration from some of those very high priced areas. And people are moving to places like Las Vegas, Phoenix, Dallas, those and Tampa, places like that are more affordable but still have jobs. That's where people are moving, and that's a red flag for those areas that are losing that net migration.
Gotcha. And by you're just mentioning those 4 cities on this podcast, that's going to now trigger at least 50 people to go off and start buying in, would you say, Tampa, Phoenix?
Those are the top ones. Yeah, I think, Las Vegas is always interesting, but yeah, Clark County, Nevada, Maricopa County, Arizona, which is Phoenix. One of the counties in Dallas, I think it's Denton County, is on that list, and then Hillsborough County in the Tampa area are the top 4 with the biggest increases in net migration. So, even though in Tampa we are seeing, for instance, and even Dallas, we're seeing some increases in foreclosures, as I mentioned earlier, I still am more confident in those markets because we've had such a population gain over the past few years that there should be more of a cushioning in terms of demand for housing in those markets.
And is that essentially, so Daren, if you had to pick like your top, this is probably an impossible question, but your top 3 or 4 criteria, like it sounds like obviously net migration is one of those criteria. What are the criteria you look at to judge a market based on its condition? If that's even a question.
Yeah, they're fairly, in some ways they're fairly simple. Housing, home sales, and then the combination of home sales and inventory. So if you see home sales going down and inventory is going up, which we are starting to see, days on market, and you mentioned it in the high end, you can start to segment markets. That's a danger sign of weakening demand. And that's a lot of times kind of the first domino to fall, is you see that weakening demand. And then the next domino would potentially be home prices, either a slowing down in appreciation or home prices actually going negative, which we're starting to see in some of these high-flying markets. And so those are some of the leading indicators. I would put even before that, a leading indicator of market health would be that population. And then population and wage growth as a way of looking at kind of the health of the job situation. Those would be the biggest part of the funnel. And then you start going down more specifically to the housing market and looking at the combination of home sales and inventory, then home prices, home price trends, and then really then the foreclosure, the distress piece of it is in some ways a lagging indicator. Although I would argue, and we can talk about it if we have time, that there are some leading indicators in the distressed market too that we can look at. But traditionally, like foreclosures, a bank isn't going to start a foreclosure until 120 days after missed payments. And that's probably after even longer, where the person was struggling. Maybe they had lost their job another 120 days before that. And so by the time the foreclosure happens, that market had, at least, or that specific situation had already been in trouble for 3 to 6 months. But anyway, that's those would be some of the main ones that I look at.
Sure. Oh, that's awesome. And you were about to touch on I think you just hit something right on the button. Leading indicators of distressed properties versus what you would call like the lagging indicator of the foreclosure activity, right? Essentially that is, are you guys tracking? Well, now I know you're at auction.com. I'm all over the place. Is there any other data or trends?
We'll edit that out.
What was that?
We'll edit that out.
We'll edit that out, right? Were there any other data or trends that you'd like to mention on the distressed market specifically that maybe you're tracking, you're following, you look for,
Yeah, what's interesting in coming to auction.com is I have access to not just the transactional data, but the buyer behavior. So the answer to that is I can look buyer and seller behavior, just a more granular look at buyer and seller behavior, because we can see what sellers are pricing assets at, and then what they sell at versus what they price them at. And this is all within the distressed marketplace. And then buyers, what they're bidding, because within an auction environment, you see the bids coming in and how close are they to what is the gap between if that property doesn't sell at auction what is the gap between what the seller wanted and what the highest bid was. And so that's interesting behavior to look at. But yeah, I mean, it actually gets back to investors. I'm looking a lot at what real estate investors are doing specifically within our platform, and how, and as a leading indicator of how confident they are in the housing market. And to me, that is a leading indicator of not just distress, but the overall market health. If we look at sales rate, that's one of the key metrics we look at, which is just basically the percentage of properties that go to a foreclosure auction that actually sell to an investor. And when we see that sales rate decline, that is an indication that investors are not very confident in the market. Mm-hmm. We saw that decline early last year, and then we saw the market slump. But early this year, we've actually seen that sales rate bounce back higher, which is evidence to me that at least investors have regained some confidence. I think there's still evidence that they're being cautious, but they've regained some confidence as interest rates have. And by the way, interest rates is another thing I should have mentioned. Mortgage rates. That's a key metric, especially in this environment, that's impacting the ebbs and flows of this marketplace. But anyway, really, so all that to say, I think it gets back to, as a leading indicator, is looking at what folks like you and others in your audience are doing, and because you're on the front lines, and so if you, and your whole business sometimes is predicated on accurately knowing what the market is going to look at like 6 months from now, when that property you've bought, you're putting back into the marketplace if you're flipping it. And so you're very forward looking, investors are very forward looking in nature, and a lot of times very short term, not always, in their thinking. And so looking at their behavior as a leading indicator, I found, going back at least the last 5 to 7 years, has been a pretty good leading indicator of the health of the marketplace.
Wow, interesting. So it all lies with us. That's kind of scary. if we buy more, market doesn't collapse, huh?
Yeah, that's right. I was looking at the results from that survey in San Diego real quick, and one of the questions was, well, I mean, one question is, how much home price appreciation do you expect over the next 12 months? And 57% of the audience there said about 1 to 5% appreciation. So the majority of investors, at least in that forum, are expecting the market to continue, but at a pretty slow pace, 1 to 5%. There were 24% who said prices would be flat or declining over the next 12 months. And that was the next biggest answer. So you have, I would say, investors are not counting on the market to be booming over the next 12 months, but to kind of be bumping along. Another interesting question here I'll just share, and then I know we're probably running out of time, but when I asked what best describes your view of the housing markets where you invest, out of 4 options, the biggest answer was overvalued with correction possible. 42% of the respondents said their market is, where they invest, are overvalued with a correction possible. Now, the second biggest answer was fundamentally sound with solid growth. So I don't have necessarily a huge consensus, but there are enough people who are saying, hey, we think our markets are overvalued, that I think that's a leading indicator that that the market we're in right now is definitely not, I don't think you can count on double-digit appreciation over the next 12 months by any means. Probably you'd be very hard-pressed to find that in any market across the country.
Yeah, for sure. And auction.com specifically, right, Daren? So we had a brief and I think open conversation at the end of our conversation in San Diego, where a few of us as a bigger player, how we source inventory, where we used to get a lot of it on auction.com, it's almost like you had enough other buyers coming to the table. Like you mentioned that, was it saleability rate? Is that what you said? The difference between
just sales rate, yeah, foreclosures.
Sales rate. So the transactions that are consummated between your clients and the customers, the sellers and the buyers on that market. Our personal opinion there, which doesn't mean anything, because with us or maybe some bigger players dropping out, there's 8 other buyers that are there to replace me on auction.com. But that's where I was one of those like negative or less than optimistic people on my own market on that survey. And I feel as though auction.com is an amazing place to get that inventory. We were just, and to be fair, I haven't looked at it in a while because we just found that there was an awful lot of people that we felt, maybe based on our ideal of the market, or that we felt that they were overpaying on those public sites. So we had to kind of go elsewhere and off market to try to find that data. Is there any data on the quality of those buyers on the auction.com site? Like, what should you be if you're an ideal buyer for that site? Where do you need to be?
Yeah, absolutely. And that's good news, bad news for us. We always want folks like you, Nick, buying from us. But on the other hand, if there are other people who are willing to pay more, we'll take them.
I understand. And
our sellers will take them too. And but we've actually recently done a survey of our buyers, and we do have some big buyers on the platform who buy hundreds of properties, even thousands of properties a year. But those are the exception. The majority of our buyers are folks buying 1 to 5 properties. And I think, my theory on that is they're able to make that work. They may not have to operate on because they're not operating on a huge scale.
Yeah.
They are able to operate on thinner margins and make it work. That said, there's still our average. One of the other metrics I look at a lot is the winning bid to value. So people who are actually buying properties, the percentage of of full market value, but of the sellers, they've gone and done a BPO of the property and said, here's what we think the value of this property is as is, not if it were after repair value. Mm-hmm. But that average percentage is 79-80% of the as is value. Okay. So people are they're buying below value. And then if you take into after repair value, it's going to be an even bigger discount on that. So there are those deals available, and in fact, on average, those are the type of deals people are getting. But it has, it is. I think it's a good thing for our I should push this podcast to our sellers out there to hear that, we've brought in enough demand in our marketplace that there are quite a few buyers, but you can certainly make it work. And I think right now, at least, it appears to be working, attracting more of the smaller investor who's buying fewer properties.
I 100% agree. And I also feel like that it's an incredible source of opportunity, especially for I think you nailed the ideal buyer. You nailed someone who can take 1 to 5 to even under 10 projects a year. They might not necessarily have an overhead they have to take care of. They might not necessarily operate on super volume numbers, but for anyone listening to this, the audience members specifically, if you're not already on auction.com, poking around, looking at some stuff, that's 78. That's a great stat you just shared. Like if it's 78 to 80% of an as-is valuation, huge. That's a huge opportunity for people out there. And do you ever find, and this is maybe a question more for your back office, but do you ever find a give and take, being that maybe your clients, they're relying on someone in the field to go out there and physically take a look at and report back on any issues, but then the buyers that go out there physically and take a look at all those issues, that's probably where a lot of that net difference lies, right?
Yeah, that's right. And sometimes I think the buyers, know more about the properties than the sellers do, because the sellers are sitting in some office thousands of miles away, and they may have someone go out. But when you're putting your money on the line to buy that property, you're going to do your due diligence and really understand that property. And part of the arbitrage there, that 78%, the reason that sellers are willing to take that is because it could cost them a lot of money to take back the property themselves. And so they're considering that. If they have to take back that property and hold it for, the average is over 200 days before they can get it in a place where they can actually sell it again. Sell it like on the MLS. That costs them a lot of money, and so they may be willing to take that 80% so they don't have to hold a property and deal with rehab and deal with the risks of holding property. But yeah, I think sometimes our buyers know more, and sometimes you'll go to a property and see, hey, this property is not as bad, I guess, as the seller thinks it is. And so this is an opportunity because you're on the ground in the market, able to see, or your market so well as an investor, hey, look, even though this property on paper is worth $100,000, I know that this neighborhood is gentrifying or whatever, and so there's a great opportunity.
For sure. I love that. And you and your team over there, have done an incredible job. You're the Goliath for off-market inventory right now, or for, seller, that specific distressed inventory, which is exactly like what our audience is looking for, especially if they don't already have, marketing engines up and running. That's where they should be going. So,
you should at least be considering it. And Nick, you should check it out too. Because there's always, there's always new inventory coming on. We had a big client recently come on, and they're pricing their properties at 65% of value, as opposed to that 80%. So and that may be for a limited time, but there's those types of deals that we see happening as well.
Super. You convinced me. Super sexy. I'm on. My biggest problem when I was on auction.com was like, I couldn't get off. Like I was like checking out every single piece of inventory. I'm like, oh, I know where that is. I think I know that one. And, it's funny because also having the short sale company, right? We do try to get all of those inventory to not go to your clients, but inevitably that's, inevitably that's where they end up, right? If they're not a short sale, they go to foreclosure, and that's, it's a tremendous source. I'm 100% with you on that. And if we can do everything we can to keep you gainfully employed, is there a good way people can get in touch with you, Daren? And if you have any takeaways or calls to action besides just getting on there and getting an account together and poking around, this is your opportunity.
Maybe we can do some follow-up at some point where we dig into more of the details of how to navigate the site. But we actually have a lot of helpful resources and videos if you go on navigating the actual process of buying a foreclosure auction property. So, but I would just recommend that. Go to auction.com, check out some of the help, and then start searching for properties and see what's available. I just mentioned we have two types. There are two types of auction. There is the actual foreclosure auction, and in not everywhere, you have to go physically to the auction on those. In Florida, actually Florida and Ohio are two big exceptions where you can actually bid online on those foreclosure auctions. And then the other opportunity is the bank owned or the REO, where it did not sell at the foreclosure auction, but it goes back to the bank. And those ones are all all online. And so one advantage with those is that you can bid. It's easier to bid on properties across the country. You don't have to go physically to the location to bid. So those are the two opportunities, but go on and check it out, register. It's free to register, but when you register, you can set up alerts for the types of opportunities that you're interested in and start finding that. But check it out.
That's awesome. And trends and data and like that stuff, I could talk that all day with you, my man. Like crazy stuff. Thank you for sharing with all the stuff you've shared.
Oh yeah, I would say if you want to check out the stuff that I'm posting, the best place to go for that is auction. I should know this off the top of my head. auction.com/in the news.
In the news. Okay. We'll put that in the show notes there. So it's auction.com/in the news for Daren's news trends columns, right? Essentially.
Posting about what's going on in the marketplace, and a lot of these heat maps that I've referred to a couple of them in our conversation today, where you can go in and look at what's happening in your market specifically.
Awesome. That's crazy. Daren, I can't think, I would love to have you back too. Maybe like, in 8 or 9 months or so, and just recheck in on data if that's cool, and on trends. Is that cool? Would you be open to that?
Sounds good. Yeah, I'm up for it. You tricked me again.
I'll lure you in I'll find out what your favorite drink is. I'll lure you in. No. Well, folks, hey, thank you all so much taking part in another episode of the Shut Up and Do It podcast. Daren really, really brought the value today. We've been playing with trends and data and talking about opinions from all of us up here in the Northeast. This is the first time we've had some real solid data to back that up. And it's absolutely crazy. So for those of you listening, feel free, please like and subscribe below this podcast. If you're on Facebook, we're on, iTunes and YouTube, and there's like 15 other places this is going to be syndicated out to. Make sure you guys like and subscribe, and go to auction.com/in the news for Daren's trends columns and what he's got going on. And we will make sure we see you on the next episode. Until then, keep shutting up and doing it.